Okay. All right, welcome everybody. Welcome to our new digs. We had a hearing this morning, and this is our initial subcommittee hearing. Sorry to see you all so far away, but this is the new way we're going to have to do business here as a result of remodeling efforts. But thank you for being here. We will call the committee to order. And without objection, the chair is authorized to declare a recess of the committee at any time. I do want to mention we've got votes coming up probably in the 2:30 to 2:45 range, so unfortunately we'll probably leave shortly and for a little while. But we hope to get through the testimony, so we'll see how it works here. This hearing is entitled TILA-RESPA Integrated Disclosure, examining the costs and benefits of changes to the real estate settlement process. Before we begin, I'd like to thank the witnesses for appearing before the subcommittee today. We look forward to your testimony. And I'll now recognize myself for 3 minutes to give an opening statement. For the majority of American consumers, the purchase of a home is the most important and expensive financial transaction they'll ever make. And the process in place today is confusing and burdensome. 23% of respondents in an October 2013 poll by the USA Today said that they would rather gain 10 pounds than go through the mortgage process. 7% said they would rather spend a night in prison than go through the mortgage process. What does that tell you about the system? I think it tells you the system needs to be fixed. And we owe it to the consumers to make sure this process works and is as straightforward and simple as possible. August is one of the busiest times of the year for home closings, when thousands of homeowners will sit at a closing table on or after August 1st. It remains to be seen whether or not parties will be ready for the new TILA-RESPA Integrated Disclosure Process, or TRID. We continue to hear from businesses that tell us industry and vendors simply aren't ready for TRID or the liability that accompanies it. This is despite having spent, according to some estimates, upwards of $100 million on new systems, vendors, and education. Dramatic changes to the settlement process paired with the reset provisions included in TRID have the potential to unnecessarily delay closings and cause a ripple effect throughout the real estate market. Strict enforcement and increased liability for lenders will only exacerbate the situation. This is particularly true for small businesses party to real estate closings that are likely to be left at the table with greater exposure and limited guidance from CFPB. For years, Congress, consumer advocates, and industry groups have called for simpler settlements. To be clear, I fully support efforts to streamline the process. No one disagrees that there is a need for improvement. But we need to go about this in an appropriate manner and take the time to ensure that consumers aren't negatively impacted by something designed for them. Consumers, industry, and the CFPB itself stand to benefit from a delayed enforcement period. I imagine that's why the Center for Responsible Lending joined a letter with the industry and has since reiterated support for a period of restrained enforcement and liability. At the end of the day, what's most important is that we get this right. Part of that is ensuring industry has the information it needs to facilitate a smooth transition. We owe it to consumers to make sure this process is worthwhile and does more than give away 5 pages of disclosure and replace it with 10. Given the approximate $100 million price tag and the years of work we need to be putting a disclosure system in place that is clear and direct, I'm not sure TRID does that. I look forward to today's testimony and gaining a better understanding of what changes to the settlement process will mean for everyone sitting at the closing table. Chair now recognizes the ranking member of the subcommittee, who today is filling in for the ranking member, but Ms. Beatty from Ohio. She's recognized for an opening statement for 5 minutes. Ms. Beatty.
And thank you, Mr. Chairman, and thank you for holding this timely hearing, and to our witnesses today. It is my honor to be here pitch hitting for Congressman Cleaver. And we are all here for the consumers, and we have heard that. But today we are here to hopefully have a better understanding of the Consumer Financial Protection Bureau's TILA-RESPA integrated disclosures and what the implementation of these rules will mean both to the industry and to the consumers. These disclosures aim to reduce the overlapping of the information received by the consumers, as well as to simplify the overall origination process, which I support. I also applaud the CFPB's efforts in engaging in consumer and industry research to put forth a good rule. In fact, just yesterday, I heard from a large contingency of Ohio Association of Realtors who are accepting of this new rule. They are not asking for change or to challenge the rule, but what they have expressed to me is that they would like to kind of have a test run, so to speak, of the rule. They need a pre-season to work out all the nuances and the new disclosures form. I kind of liken that to a new rule in my district when people were speeding and they decided that they were going to put up cameras. Well, they gave them a 30-day notice to kind of get used to it before they enforced it. At the end of the day, we are here to bridge the gap between effective compliance and ensuring that the rules implementation is in the best interest of both the realtors and the home buyers. We've heard the stories from the chairman about how difficult it can be for those who are buying their first home. And any of you, if you've purchased that home, you also know about the plethora of paperwork and the forms that have to be signed. And in the aftermath of the 2008 housing crises, I hope to learn today that all consumers, both buyers and sellers, will have the proper education and understanding of the TILA-RESPA disclosures to make the mortgage loan closing process as fluid and seamless as possible. Thank you, Mr. Chairman, and I yield back the balance of my time.
Thank you, Ms. Beatty. Today we welcome to the hearing four great witnesses. First is Ms. Cynthia Lohman, President, United Bank Mortgage Corporation, United Bank of Michigan, on behalf of the American Bankers Association. Ms. Diane Evans, Vice President, Land Title Guarantee Company, on behalf of the American Land Title Association. Ms. Lori Goodman, the Center Director, Housing Finance Policy Center, Urban Institute. And Mr. Chris Policron, Executive Broker, First Choice Realty, on behalf of the National Realtors Association. Thank you all for being here. With that, I will recognize myself for 5 minutes to give my testimony. Go ahead. Oh, okay. With that, I will allow each of you, how's that, to go ahead and give your testimony. Ms. Lohman, you get to start today, 5 minutes. Thank you very much.
Chairman Lukemeyer, Ms. Beatty, my name is Cindy Lohman. I am President of United Bank Mortgage Corporation, which is a wholly owned subsidiary of United Bank of Michigan. We are a $468 million community bank based in Grand Rapids. I also serve as the chairman of the ABA Mortgage Markets Committee. I am pleased to be here today to testify on behalf of the ABA on concerns over the pending implementation of the Truth in Lending and the Real Estate Settlement Procedures Act Integrated Disclosures, known as TRID. These rules are scheduled to go into effect on August 1st this year. Between now and then, banks and their vendors must undertake a tremendous amount of work to comply with these rules. In cases like mine, banks may not even have the third-party systems that they need until after the deadline. The real impact of this rushed deadline will be felt by consumers, who will face costly delays in getting the credit they need to buy a home. This is why we're joining with members of this committee in requesting that the CFPB formally announce a clear delay of this enforcement. TRID will impact every mortgage loan made in the United States. It is critical that this rule is implemented smoothly so that it does not end up hurting creditworthy customers that want to own a home. Although intended to simplify the disclosure process, if not implemented properly, TRID could add significant complications that will end up costing consumers. TRID's objective of integrating consumer disclosures is commendable. TILA and RESPA both serve important purposes, but the disclosure regimens developed under each statute have swelled in complexity. The sheer volume of documentation overwhelms the borrower, and true disclosure has become virtually meaningless. ABA and consumers and industry groups have sought for years to streamline and simplify this process. The CFPB, to its credit, undertook this project in an open and responsive process and incorporated many changes and urged by industry participants. Despite this, the new forms remain lengthy and intimidating to the average customer. Given the scope and complexity of these new rules, this implementation of regulation will impose high costs on all lenders and consumers. Our most urgent concern right now is the looming August 1 deadline. Between now and then, banks must fully review all of the final rules, implement new systems, processes, and forms, train staff, test these changes for quality assurance before we bring them online. Implementation is further complicated by the fact that most smaller community banks rely on vendors for regulatory compliance and the accompanying software updates and system upgrades. An alarming number of banks report their vendors are not yet ready to provide the necessary updates to individual institutions. An ABA survey shows 79% of banks cannot verify that they will have the systems by the deadline. For some institutions, stopping any mortgage lending is the answer to this deadline because the consequences are too great if the implementation is not done correctly. At my bank, we are still waiting for systems from our third-party providers and do not expect some of the product offerings to be available in our software system by August 1st deadline. This means that as of the deadline, I will be able to take mortgage applications, but will not be able to close certain loans where I do not have systems in place. We must get this right for the sake of our customers, our bank's reputation, and to promote the recovery of the housing market. There are very reasonable solutions that Congress envisioned that enable the Bureau to avoid the negative consequences of an arbitrary August 1st deadline. ABA strongly supports the efforts of Chairman Lukemeyer and Neugebauer and Representatives Maloney and Barr in asking the Bureau to treat the time period between August 1st, 2015 and December 31st, 2015 as a hold harmless period for enforcement and liability under the new rules, and to formally announce such period to ensure that the prudential regulators and secondary market stakeholders do the same. ABA thanks Representatives Pierce and Sherman for introducing H.R. 2213, which provides for a hold harmless period. We urge quick action to avoid the potential harm to our mortgage customers. The bottom line is this: these are complex rules, and implementing them must be done in a careful manner. If implementation is rushed ahead of schedule, it will only lead to confusion and delays that will be costly for consumers. Thank you, and I would be happy to answer any questions.
Thank you, Ms. Lohman. We'll get you a prize. I think you're one of the few witnesses I've ever seen in this committee that actually finished ahead of schedule significantly. Thank you very much. Ms. Evans, you're recognized for 5 minutes.
Chairman Lukemeyer, Member Clay, Beatty, and subcommittee members, my name is Diane Evans, and I am Vice President of Land Title Guarantee Company, a title insurance agent in Colorado. I joined Land Title Guarantee Company 34 years ago when I opened a branch in my hometown. I also have the privilege of serving as the president of the American Land Title Association, the national trade association representing the abstract, real estate settlement, and land title insurance industry. ALTA has more than 5,400 member companies ranging from small one-person operations to large publicly traded companies. Our industry employs more than 108,000 professionals, and our members have offices in every county in the United States. In 78 days, our industry faces its biggest regulatory change I've seen in my 34 years in the business. I'm talking about the implementation of the Consumer Financial Protection Bureau's TILA-RESPA Integrated Disclosures, or TRID, as you're hearing it called. As president of ALTA, I've had the opportunity and privilege to travel across the country and talk to lenders, to real estate agents, and to settlement professionals about this new regulation. The main lesson from those conversations is that collaboration is crucial. The new regulation is overreaching, it's expensive, and it's confusing, not only for small companies, but for large companies as well. Implementing TRID requires more than just simply updating our systems for 2 new forms. It requires a paradigm shift in the way we do business, in the way real estate settlements occur across this United States. Our industry will invest almost $1.3 billion to comply with this regulation. After August 1st, if a consumer better understands their transaction, it will be worth it. Let me tell you a little about my company. We've been spending a great amount of time coordinating with our real estate community. We have already trained over 1,000 real estate agents. We've worked with 300 lenders, and we've worked with their employees, and over 60 home builder employees to understand this new process. It's taken many of our staff away from their regular jobs of serving home buyers each and every day. There are two ways that Congress and the CFPB can help industry implement TRID. First, the CFPB absolutely must fix their requirement that consumers receive inaccurate prices for title insurance. This is the only cost under the new form and under the new rule that the CFPB prevents home buyers from knowing the actual amount they'll pay for title insurance. Purchasing a home is one of the largest investments a consumer makes in their lifetime. Home buyers want and need to know the true costs of that transaction, including the one-time cost of the title insurance premium that protects that investment. TRID fails consumers in that regard. Second, the CFPB should provide a hold harmless period, as we've heard from other witnesses. While the CFPB has provided some helpful assistance on implementation, our members need more time to ensure that process changes demanded by TRID won't result in delays for those home buyers. This is why we strongly support H.R. 2213, and we thank Congressman Pearson Sherman for introducing this legislation. Without that hold harmless period, consumers may experience delays, and realtors, lenders, and settlement agents want to make sure that that doesn't happen. Disruption or delays in real-life transactions don't just affect one family. Its consequences affect more. In a typical transaction, the seller of one house is going to be the buyer of another. The domino effect of one's closing being delayed results in a number of families being stranded, leaving them looking for alternative housing with moving vans sitting in their driveways. Our members conduct closings each and every day and take great pride in helping consumers protect their home ownership. Help us ensure that home buyers leave our offices with keys in hand and better understand the cost of their transaction, including that of title insurance. I appreciate the opportunity to be here, and ALTA is eager to serve as a resource. Thank you.
Thank you, Ms. Evans. Ms. Goodman, you're recognized for 5 minutes.
Mr. Chairman, Ms. Beatty, and other members of the committee, thank you very much for the opportunity to testify today. My name is Lori Goodman, and I am the Director of the Housing Finance Policy Center at the Urban Institute. The Urban Institute is a nonpartisan research organization located in D.C. The Housing Finance Policy Center provides timely, data-driven analysis of policy issues relating to housing finance and the housing market. Prior to joining Urban 2 years ago, I spent almost 30 years as a mortgage-backed securities analyst and head of securitized products research and strategy groups at several firms, including Amherst Securities and UBS. The views expressed in this testimony are my own and should not be attributed to the Urban Institute, its trustees, or its funders. Today, I want to cover 2 points. First, I will discuss the TILA-RESPA integrated disclosure and make the case that the CFPB should offer a hold harmless period through the end of 2015. Second, I will explain why these disclosures are really a minor operational issue in the context of a housing finance system that is stuck in limbo. Resolving this limbo by finishing the work of reforming Fannie Mae and Freddie Mac is the most important issue facing this country's housing market today. I'll start with the new disclosures. The 2010 Dodd-Frank Act tasked the CFPB with combining the 2 sets of disclosures borrowers receive and rarely understand into one consumer-friendly form. The CFPB completed this enormous task in November of 2013, and after a few further tweaks has scheduled it to take effect on August 1, 2015. I believe the CFPB has done a good job here, and the results will definitely improve the closing experience for the borrowers. But lenders need more time to implement this enormous change. The August 1st implementation date is too tight for many lenders. Yes, they have had 21 months to implement these changes, but lenders could not begin systems development until the data elements in MISMO, the Mortgage Operation Management System, on which they were all dependent, was complete, and that happened just 3 months ago. And it takes time to develop a new system, integrate into existing loan origination platforms, and train your staff. These new disclosures won't meet the end goal, improving the consumer experience, if lenders are not ready to implement them. What will happen instead is that lenders will delay and avoid closings. A hold harmless period is the best of both worlds. It requires implementation, but offers lenders the necessary protection to begin doing their job, making loans. So I would urge the CFPB to provide a reasonable hold harmless period through the end of the year following the August 1st effective date of the TRID regulation. Now let's talk about the real elephant in the room, the unfinished business of reforming Fannie Mae and Freddie Mac. The great news is that all the work done to reform the GSEs was not wasted. It has allowed me and many on both sides of the political divide to conclude that the goals of legislative reform should be to preserve the 30-year fixed-rate mortgage, assure broad access to credit, and move the bulk of the risk to the private market. There has been a growing recognition that the government, and hence the taxpayers, must bear the catastrophic risk, but this should be insulated behind private capital, so the risk it is ever tapped is remote. Yes, there has been significant progress through administrative channels in lieu of legislative movement. The FHFA has tackled the issues of lenders adding their own, more restrictive requirements to the GSE's requirements by clarifying when the GSEs can put loans back to lenders and by curbing compensatory fees applicable to delinquent loans on the servicing side. They have also brought private capital back through the CAS and STACR back-end risk-sharing transactions and transactions with reinsurers. There have been a few transactions where risk has been shared at the point of origination. And the FHFA has instructed the GSEs to begin work on the common securitization platform and has put forth a proposal for a single security. And yes, there are additional steps the FHFA could pursue, including creating structures which provide discovery of market pricing and expanding the common securitization platform to include other market competitors. But even so, administrative reforms cannot take us all the way, and that presents an opportunity for Congress to make a real difference. Without congressional action, as a practical matter, the GSEs cannot be taken out of conservatorship, and the system cannot allow for additional competitors. We urge Congress to move forward and address these issues in a careful and thoughtful manner. Thank you.
Thank you, Ms. Goodman. Mr. Policron, you have 5 minutes.
Thank you, sir. Chairman,
Please turn on your mic.
that would be helpful.
There we go.
Chairman Lukemeyer, Ms. Beatty, and subcommittee members. I'm Chris Policron, the 2015 President of the National Association of Realtors. I'm a commercial and residential realtor and executive broker for First Choice Realty in Hot Springs National Park, Arkansas. On August 1st, 2015, significant RESPA TILA changes will go into effect. NAR is generally supportive of this move to harmonization as long as it benefits consumers and makes the real estate transaction smoother. However, we see potential bumps in the road that could cost families time and money and cause serious frustration. It is clear that RESPA TILA integration is going to be a learning experience for everyone. Before I get to the heart of my testimony, I would like to thank Chairman Lukemeyer for weighing in with the CFPB on this issue. I would also like to thank Congressman Barr and Congresswoman Maloney for their bipartisan sign-on letter to the CFPB, and finally, Congressman Pierce and Congressman Sherman for their bipartisan legislation to aid in this effort. NAR and a broad coalition have sent a letter to Richard Cordray, Director of the Consumer Financial Protection Bureau, outlining our concerns. Here is what we communicated to the Bureau. First and foremost, NAR has asked the CFPB to make August 1st, 2015 through December 31st, 2015, a trial implementation period of restrained enforcement. During this period, the industry will operate under the rule and new forms, but be held harmless in terms of enforcement and liability as long as they act in good faith. Industry and the CFPB can then collect data on problems and develop solutions to minimize costly and harmful impact on consumers. This 5-month testing period should provide enough time for everyone to get it right. It also means that the full-fledged implementation from some of the busiest months in our industry to the least busy months of January and February. We're asking for this grace period because of the potential impact to the consumers. Even if only 10% of the transaction experience issues with the rule implementation, the numbers will still be significant. That could mean as many as 40,000 transactions a month with problems and potentially many more. This is certainly something realtors and the industry would like to avoid. The good news is there's a precedent for the CFPB to create such a period. The Department of Housing and Urban Development took a similar approach when we revised the RESPA disclosure in 2010. We believe that effort should serve as a model for the CFPB and would produce the best outcomes for everyone involved. We believe the CFPB can provide more detailed written guidance on a number of issues, clarify where RESPA and TILA liability apply, and that the pre-approval process can coexist with the rules regarding issuance of the loan estimate. Ensure that consumers can still choose an agent that closes the transaction without lender interference, the same way one chooses their lawyer to represent them and not their opponent. And finally, provide more information and flexibility on the bona fide financial emergency waiver and other waiver authority. Overall, realtors understand that RESPA-TILA integration is a monumental effort, decades in the making. The CFPB has done good work, and we hope a few small steps can help take this giant leap forward. We continue to work with the CFPB and our industry partners in this effort. Thank you for this opportunity to testify, and I look forward to answering any questions.
Thank you, Mr. Policron. Yes, with that, I'll begin the questioning and recognize myself for 5 minutes. Mr. Policron, one of the arguments that CFPB uses for their date of August 1st is this is a slow time of year for applications/closings. You're in the business. Tell me.
I am in the business, and that is an erroneous statement.
In a 1 to 12 here, we got 12 months. Where does August rank in the
busiest?
Busiest.
Third.
Probably third. Okay.
I have statistics for that, sir.
Perfect. That's what I'm looking for. That's the answer I need, because we need that information to be able to refute what they're saying. So thank you for that testimony.
You're very welcome.
Ms. Lohman, I recently met with a group, excuse me, I spoke to a group on Monday of bankers, and they were talking about this issue. And I told them, I said, you really got two choices. One is either stop lending for a period of time prior to and thereafter August 1st, excuse me, or you fill out 2 sets of documents and hope that by handing the examiners 2 sets of documents that you're compliant and let them take their choice. And so I'm kind of curious what your solution is, because I just got done talking yesterday with one of the largest mortgage lenders in the country, and they're going to go the route of 2 sets of paperwork. This is double cost for them. They're going to eat the cost of this because they don't want the consumer to bear it, but by the same token, this is going to be very, very cumbersome to protect themselves against the liability exposure of making a mistake. Can you tell us what your bank is and what your thought process is on that?
Well, as you know, anything that we do after August 1st falls under the new rules, but we still will be closing business from the prior applications, so we will be using 2 sets of documents throughout that period anyway. As I indicated earlier, I've been working side by side with my software company since last year. They have not been able to produce the final documents to a satisfaction of our staff, so we are now just starting the testing of those documents. We are not handing any of those new documents to customers as of this point in time.
What do you estimate is your time to be able to be compliant? Do you think you'll be able to get it done by the 1st of August, be able to have your software and systems in place that you can comply?
We are being promised that most of our documents will be available, but there'll be some loan products that we offer, including the rural development product for 100% down on low income, that will not be available on August 1st.
Okay, you represent the ABA, so across the country, what is the consensus that most banks will be in compliance or be able to be compliant, or most will not be able to be compliant, or do you have a percentage, or what's your thoughts on it?
We do have statistics on that, but the understanding is that most of our banks are concerned that they won't be compliant. There may be the last minute where the software companies will produce, but then we're concerned about procedures, processes, and testing.
Very good. Ms. Evans, title insurance folks normally do the closings on a lot of real estate
That is correct.
transactions. Is that correct?
That is correct, yes, sir.
Under the new proposal, is that regimen going to change, or is this going to be the same, or what do you foresee happening?
Well, I think the processes could change. That's part of the reason why collaboration and discussion and education is so important, and the hold harmless period allows us to work through those issues to make sure that in working with Ms. Lohman's bank, we may do it one way, and working with the next bank, it may be different. But we need to make sure we have the opportunity to engage in that dialogue and make sure we understand that so the home buyer isn't interrupted in his transaction.
Well, to me, it's kind of concerned because if there's not a consistency here, if there's not something that's done a certain way most of the time, that leaves the possibility for problems to be there. And to me, if you're constantly, this is a moving target here. I assume that you got some plans on that.
Well, the new rule specifically has put forward forms and put forward some timelines that we must comply with, but it still recognizes the role that title and settlement agents have in the process, and has encouraged us to continue to work with our bank and lending partners to determine what's the best process for the consumers in our marketplace.
Thank you. One more quick question before my time runs out here, and you can just probably give us a real quick answer. You made comment during your testimony that the consumers don't know the cost of title insurance. Can you elaborate on that just a little bit?
Yes, I'm happy to. Thank you. The rule has a ridiculous and inaccurate formula for which to disclose title insurance rates to the consumer, and it in fact is wrong in about 43 states and totally inaccurate in 26 states. And we would ask that the CFPB correct that calculation and remove the formula from its rule, because if we just disclose the actual cost of the title insurance product, the problem is solved and consumers know the answer.
Thank you very much for your testimony. I'm out of time. With that, I'll yield to Ms. Beatty, the ranking member today, for her 5 minutes.
Thank you, Mr. Chairman, and thank you to all our witnesses for being here. And certainly as I look around this committee room, I imagine that probably more than half of us have participated in that mortgage loan closing process. And we've sifted through the hundreds of pages and provided countless signatures because we want part of that American dream. To be a home buyer and to own a home. As you heard from me earlier, I've heard from my realtors, and they don't want to necessarily change or challenge it. They just want that hold harmless period. They've expressed to me that a possible gridlock on the transactions could occur if the rules are implemented before they're given a chance to fully understand them, to come in compliance, to be trained. Ms. Lohman, can you walk me through a closing process under CFPB's TILA-RESPA disclosures and highlight what you anticipate could cause hiccups in the mortgage loan process?
From what we understand, the biggest changes that are being proposed for the August 1st new rules has to do with the lockdown of the transaction 3 days prior to the loan closing. The lender is at 100% liability for what's on that closing disclosure. For those of you who have bought a home, you'll know that in a lot of cases, there are numbers that are changing within hours before the closing. That can't happen anymore. If something is to change, it stops the closing and pushes it back out 3 more days at minimum. So those are the concerns we have in working with our partners, the realtor community and ALTA groups, that we are 100% responsible. So therefore, we're going to have to lock that document down.
Okay. Mr. Polychrome, in Ms. Goodman's written testimony, she stated that without a hold harmless period or a grace period, the severe consequences for errors under the TILA-RESPA may cause lenders to reduce originations or ultimately harming the borrower as it was designed to help. Do you agree with this assessment?
I do agree with it, and in this period, we certainly don't need fewer lenders making money. I mean, our inventory, our loan process is difficult enough right now with credit scores, et cetera, to put this extra burden upon it.
Ms. Evans or Ms. Goodman, can you comment on what the grace period from CFPB's TILA-RESPA disclosures based on good faith compliance efforts would allow realtors to accomplish?
What it allows is for everyone in the real estate transaction, all the real estate professionals, to really work through real-life transactions to understand where there might be bumps in the road, where there might be delays that would cause a home buyer concern, and also recognize that we can work out those systems without the fear of any kind of enforcement or penalty.
Just to elaborate a little bit more, you know, it's important to realize, as Ms. Lohman said, the systems are just being delivered now. In many cases, they still have to be integrated with loan origination systems. So, and in many cases, either you can't do certain products or there's a heavy manual feature. So the possibility of errors is very, very large in the early months on all sides. And giving and in addition, there are parts of the CFPB rules that are a little bit unclear. And this just gives you time to both clarify and work out and test the systems bugs. It's really, really important to get this done.
And lastly, since your customers are our constituents, let's just assume this doesn't happen. You're not given the grace period or the whole harmless. What happens to me as that home buyer coming in?
The idea would that you would sense nothing is happening to you, because we're still trying to deliver a mortgage to you for your home purchase. The risk is that after 50 years, in the combination of RESPA and TILA, there now is civil penalties that are going to go along with mistakes. In my world, working with my regulator, if I make 3 errors in a row, that's considered pattern and practice, and I can be fined for that. Those are the risks to my business, not to the customer, but to my business, and ultimately then to my customer if we can no longer operate efficiently and have to change those costs for our customers.
Thank you.
Thank you. Next up is the distinguished gentleman from Georgia, Mr. Westmoreland, for 5 minutes.
Thank you, Mr. Chairman. And first of all, I just want to give a couple of comments. You know, and I say this to most of the witnesses that come here with the unintended consequences of what Dodd-Frank has created, and specifically the CFPB. In fact, a lot of us that were not on the committee when Dodd-Frank was passed, we feel kind of like that guy in the circus, walking behind the elephant with a broom and a shovel. The elephant, you know, is Dodd-Frank, and we need to get rid of that elephant. I was in the real estate business for over 20 years. I've been to many, many, many closings. And I've bought things myself, and the majority of the time, the purchaser wants to know how much money he's got to have. He wants to know what his note is, possibly the interest rate, and that's it. And so, you know, when I started selling real estate, you could have a one-page contract. And now, you know, I think they're going to get to the point to where you're going to have to give the buyer an IQ test to see if he's smart enough to even go to closing. We need to be giving the IQ test to some of these people at the CFPB that are making up these rules, that have never sold a piece of real estate, they've never made a loan, they've never written title insurance, they've never experienced this. And just some of the things that you've mentioned is just a little bit of the collateral damage that's going to happen. When you have a purchaser, and I'll say this, in the hundreds of closings I've been to, I have never seen, you know, the interest rate change, the note change, the price of the house change. There may be some adjustments in some tax escrow or something, but not really anything to affect that sale that would cause you to have to put the paperwork back for another 3 days to mail off to get somebody to look at it. That's insanity. Part of the real estate industry, what we made was the fact that everything had to be disclosed between the buyer and seller. But even in this case, as I understand the rule, the buyer would have to do a handwritten note explaining the differences in this and send it back. This is pure stupidity. I mean stupidity. And in fact, I would encourage the CFPB before they make any of these other rules is to have some people that are actually doing this business to come in and say, hey, how can we make this simpler on the buyer? I promise you, this the whole deal was intended to make it simpler for the buyer. If you want to make it simpler for the buyer, don't have him sign stuff where he waives his rights away, or he is just doing something to make sure he has signed a paper to say that he understands the last paper he signed. And then after he signs that, he'll sign one that said, I understand the last 3 papers I've signed. That doesn't make him understand what's going on. And so it's a good real estate agent. It's a good mortgage person. It's a good attorney. Those are the people that make that customer understand what he's doing. And I think y'all do a very good job of it. Now I will ask a question. Ms. Lohman, the CFPB's whole reason for this was consolidating it to make it streamline it for paperwork. Do these new forms in any way that they're designed give borrowers a more accurate picture of what they're doing?
No, sir. If I had been a part of the original transaction, I wouldn't have to explain it today as a first-grade story problem where the information is fragmented through the report. I have to train my closer to be able to make sense of that to the borrower. I have to train my closer how to explain what a tip is, and it's not a restaurant, it's the total interest paid, and why that's important for the consumer to understand.
So it's not simpler, it's not less paperwork, it's really more complicated. You feel like, from the experience that you have, we have made it more complicated than simpler.
Yes, that's what I believe.
Thank you. And I think that would be true to all the witnesses up there, is that we've taken something and made a mess of it, and we're just really good at that. So hopefully we'll be able to postpone this ruling. Thank you.
Thank you, gentlemen. With that, we go to the distinguished gentleman from Minnesota, Mr. Ellison, for 5 minutes.
All right.
There's a button there somewhere.
Oh, right here. Yeah, thank you.
We didn't come with the directions, did we?
Yeah. Anyway, Mr. Chairman, Ranking Member Beatty, thank you very much. And also thank you to all the panelists. We really appreciate your help, and all the information you share with us helps us make hopefully better decisions. Ms. Goodman, one of your fellow panelists, Ms. Lohman, offered her views on whether this change, this consolidation, would be of benefit to the consumer, and she doesn't think that it will, and I respect that based on her experience and study. Do you share the same view?
I actually think it will be beneficial to the consumer to the consumers at the end of the day. When they walk into when they walk in for closing, they will know exactly what those closing costs is going to be, which is assurances they don't have under the present system. I think it really does help at the end of the day improve the consumer experience, but it only helps if it's implemented properly.
Thank you. So I just, in due respect to all the panelists, I just want to make sure that people who are watching this know that there are at least 2 sides to the story. I think that's just fair. Ms. Evans, I'd like to learn a little bit more about ALTA's membership. How many of ALTA's members are engaged in what RESPA would define as affiliated business arrangements?
Thank you, sir, for that question. We don't know. That's not data that we capture. We capture the identity of those members that provide title and settlement services.
Okay. So let me ask you, just follow up. In order to neutralize advocacy efforts for a trade organization, I have to imagine that the number of impacted members who identify as affiliated business arrangements must be a significant number. Is that right? Without asking a numerical specificity, it's a good number. Would you? It's, I don't know. Would you say half? Would you say, what would you estimate?
I really don't have actual figures on that, but I do
Okay.
not believe half is accurate, sir.
What would you say?
I would say it's far less than that.
25%?
I really don't know, sir.
Mr. Polligren, do you have a view on this?
I saw that statistic at one time, and I know it's less than 50%. I think it's
Okay.
closer to 25 than 50.
Ms. Lohman, did you have a thought on this?
Only that TRID does require, with you have an affiliate business arrangement, that it's 100% zero tolerance.
Okay. Going back to Ms. Evans, I noticed in your testimony you note the majority of our members are small businesses with the average title agency earning $156,000 in gross annual revenue and employing 3 or few people. So could you tell me, is there any reason why Alta does not keep the information about the affiliated business arrangements?
It's not a matter of whether you're an affiliated business or not to qualify for membership with the ALTA.
Okay.
We represent the title insurance industry.
Okay, and I appreciate that. I just thought, you know, is that information you could perhaps, if you had the time, share with me later on if I were to submit a question to you?
We certainly consider it. It's not anything that we even capture, so we'd have to go back and determine if that's an appropriate inquiry to make to our membership.
Okay, well, thank you. I'd also like to ask you a little bit about financial benefit for referral. So under RESPA, it prohibits financial benefit for referral. Yet there are so many ways that realtors, home builders, lenders, mortgage brokers benefit from a referral. A way that's currently legal, a shared ownership interest, and ways that are currently illegal but practice lower desk rents or bonuses for realtors, special event tickets, things like that. You know, we'd be a little surprised to learn that dentists could receive a benefit from referring a client to an orthodontist, or that a lawyer could receive a financial benefit by referring to another lawyer. In fact, for both of those, doing so could get you into some difficulty, depending. So, Ms. Evans, could you share with me, why should referral sources be allowed to receive benefit or payment for the referral of settlement service businesses?
Well, sir, I believe that RESPA very strictly prohibits the payment of a thing of value or the giving of a thing of value in exchange for the referral of business. And the enforcement of RESPA we are continuing to see today, both at the CFPB level and at the national level, or excuse me, at the state level through our state regulators. So it should not be tolerated and is not permitted, in my opinion.
Thank you, ma'am. And so do you think that the overall cost of a referral, as for those, am I out of time? Oh. Do you think the overall cost of a referral, as those are used in the affiliated business arrangement, business structure, is included in the cost of operating a title insurance company?
RESPA clearly permits an affiliated business arrangement under certain circumstances with very set guidelines. And so there is no reason why it should be disallowed. It must comply with the standards set under the law.
I've gone over my time. Thank you very much, Ms. Evans.
Thanks, gentlemen. With that, we go to the distinguished gentleman from New Mexico, who is also one of the co-sponsors of H.R. 2213, Mr. Pierce, for 5 minutes.
Thank you, Mr. Chairman. Appreciate it. Would like to ask unanimous consent to submit a letter from 16 different agencies or different groups who are supporting 2213.
Without objection.
Thank you, Mr. Chairman. Also, I would draw to the attention of the panel that or the members here that a small title group in my hometown just recently called about the last week saying they had to spend $100,000 on a program to try to implement this this new regulation, and they're not sure that that's going to do it. And for a small company, that's extraordinarily difficult. Ms. Evans, I was absolutely pleased to hear that you say you don't track that information that was being requested by my colleague. Now, keep in mind that we watch the NSA track every damn thing for every individual in the whole country, and so they're probably going to call us and tell us the answer to all the questions that we just heard. But I'm glad that you're not tracking it, because I think that the government knows enough about us already, frankly. Ms. Evans, if you were going to speculate, would the larger title companies or the smaller title companies be more disadvantaged by the coming rules?
I think we're going to share that pain equally. It actually depends on, as Ms. Lohman said, the ability for our software providers to provide us the services and the systems that we need, but it also relates to the markets that we do business in and the banks and lenders that are our customers in those markets.
Having been a small business person myself, I worry at the number of small businesses who can afford $100,000 software. I'll just tell you that. And when businesses start closing down, I know where they're going to close down first. They're going to close down in the small communities, the smaller communities first, and someone from outside is going to come in and service that, and now you've lost contact with your customer base. And I just see disadvantages for the smaller places, for the poorer places. Obviously, the lower the income levels, then the less attractive that's going to be to outside providers. And so I worry about the loss of jobs in areas like New Mexico, because we got a lot of small communities, a lot of communities under 25,000, and so I worry about that. Have you all done any studies on the pressures that would cause companies to close?
We haven't done exact studies, but we have talked with many of our members across the United States that are exactly like you describe in your local communities. And they are very concerned about the ability to continue to serve consumers, home buyers, and sellers in their markets, and making sure that they have the systems and the financial stability and able to go forward.
Ms. Goodman, I really appreciated your testimony, and I thought that it came across covering both sides of the issues very well. And I will tell you, as one of the Republicans, I was a little alarmed when you said you're going to take aim at the elephant in the room. And so, other than that, I was okay with it. But sorry, it took a while to catch on there. Again, as a small state, I worry, and I really appreciate your comments on GSE reform, and that's kind of where I'd like to track toward. Again, the small state, the manufactured housing is 50% of the houses sold in my district, and so I worry that the secondary market, private market, would actually get out and service these. Have you all done any studies on the privatization and the private sharing of risk? I'm not trying to put words in your mouth. Have you all done any studies about that?
We've done a lot of work on risk sharing between the GSEs and the private markets. We have not, and we've done a lot of work on credit availability. And one of our concerns is that those being squeezed out of the market now are those those borrowers with lower credit scores, and disproportionately those are manufactured housing.
That would be my worry.
We have not done anything explicitly on manufactured housing, although we have done a lot of work on credit availability. But that is an interesting topic to add to our research agenda. Thank you.
I'll tell you what, if you would like to come and visit our office, I would like to dig into this a little deeper. If we had the capability to do it ourselves as an office, we already would have. It's just very complex. And I, again, appreciated your testimony and would invite you to come.
Thank you.
All right.
I accept.
Okay, Ms. Lohman, you had mentioned the risk to your business if you make bad disclosures. Can you tell me a little bit more about that risk and how it pyramids up or down, or whichever way pyramids go? I don't know exactly. Not coming from Egypt,
It'll get broader at the bottom, I can tell you that. What we've seen since 2010 is a zero tolerance in compliance. And the compliance, again, doesn't impact the consumer directly. It impacts my business and that of all the mortgage lending industry. And I think it was intended to improve the delivery of information to the customer, but the measurement now is that you can't make a mistake. For an example, If I disclose to a customer an incorrect title insurance fee, I eat the difference if it's wrong.
Yeah,
That's the
so
new
that
rules.
zero tolerance ought to work backwards toward the government regulators. I've extended past my time, Mr. Chairman. Thanks for your tolerance.
Thank the gentleman. With that, we go to the gentleman from Texas, distinguished gentleman, Mr. Williams, for 5 minutes.
Thank you, Mr. Chairman. And I want to thank all of you for your being here today. This is great testimony. We appreciate it. I'm a small business owner. I'm from Texas. And I can tell you that regulations are killing Main Street. You all are Main Street. I'm Main Street. The CFPB, as you've heard some of my other colleagues, I believe is not a friend of Main Street and is doing a lot of harm in America. And in full disclosure, I'm a car dealer, so I feel your pain. My question for Ms. Lohman, or my statement is, in your testimony, you discussed third-party compliance systems and that vendors will deliver these in stages, and many of them will not be ready by the August 1st deadline, which we've talked about. As a result, these lenders, especially the smaller financial institutions, will have to halt their mortgage lending business, as we've heard. And I can tell you in some of the rural parts of my district in Texas, CFPB is already regulating them out of the mortgage market. Personally, I think you're starting to see what I would call a forced consolidation of these banks. I know it's happening in Texas, because in Texas alone, where we think we got the greatest economy in the world, in Texas, we've still lost 115 community banks since 2012. Now, because, look, you know, that's what it's all about. I mean, I really think protecting these small institutions who can barely afford to comply with this new law and can't afford to be held liable should they get it wrong. I mean, you know, we hear all the time community banks and lenders are hiring more compliance officers than our lending officers. And that's just wrong. So going back to my question, Ms. Lohman, what might the fact that the products that are not going to be ready, how will they affect the bank as a whole? You've talked a little bit about that, but tell us again.
Part of my market in West Michigan, and we feel we have a very strong market as well, is the service of zero lending to low and moderate income folks. And rural development is one of those very good products that we use, which comes from ISTA. And we will not have those documents ready. I've already been told by my software partner that that is on the last part of their upgrades. If I can't do rural development, I can't do 100% lending for the low and moderate borrower.
So who's affected? The customer again?
The customer.
By big government getting involved. Second question, how might a bank make up for the lost business? You're going to have lost business because you can't sell the product, right? Because you're not ready for it. How are you going to make up for that lost business, those lost profits?
We're all in business, and we're a for-profit business, but I've done some studies just since Dodd-Frank Act. It takes me 3 hours longer for every applicant. I think the customer is the one who's suffering in the long run. We can't get to all of them. That means that some folks are not going to be able to do their mortgage with their local lender. Because
the overreach of the heavy hand of government, you're probably going to lose some, you're going to lose some profits probably because of your inability to reach out to everybody. Now, would the same lenders have to raise costs on consumers to make up for the mortgages they couldn't make until their systems were in place?
We've done some studies on that through the ABA, and 5 years ago it cost about $5,000 all-in cost to do a mortgage. We have anticipated by the end of 2016 it's going to be over $9,000 to do that same mortgage for the consumer.
So there again, the consumer is affected. I still have some time. My question would be for you, Ms. Evans. Nice to see you again. Thank you for being here. What are you seeing in the overall title insurance market as a result of this legislation? For example, I'd say, do you see consolidation in the market, or are small businesses, are they thriving in this regulatory environment?
They most certainly are not thriving. They are struggling, and there is discussion of consolidation. There's discussion of some closure because of the simple inability to comply with overregulation and the burdens placed upon them.
So it affects competition?
It absolutely affects competition, which directly affects the consumer.
The consumer, again, is affected by the heavy-handed of overreach of government.
Yes.
Yes, ma'am.
Can I share one thing on that title insurance piece? One of the comments that Ms. Evans made earlier about how TRID is regulating how we disclose that. Right now we have what we call a simultaneous issue policy, that borrowers get to have a savings when we do the owner's policy, mortgage policy of the same company. Under the new rules, because we have to disclose the full cost and we can't disclose simultaneous issue, most companies now are stopping simultaneous issue, which I did some studies on a $100,000 loan. That costs the borrower $200. On a $250,000 loan, that costs almost $300 in net savings they will not be able to experience because the title industry is saying we can't offer it.
The American dream gets further and further away. Thank you, Mr. Chairman. I yield my time back.
Thank you, gentlemen. With that, we go to the gentlelady from Wisconsin, Ms. Moore. 5 minutes.
Thank you so much, and I want to apologize to the panel for not being able to attend earlier so that I could hear some of your testimony and some of the other questions, so you must forgive me if I am redundant in any way. Thank you for joining us. I guess a couple of concerns that I have. We could start out with the August 1st, 2015 deadline for the new real estate settlement procedures and truth in lending forms, the merged form. I am on a letter with Ms. Maloney to delay implementation of this because there's a concern on the part of many of us that this is just not enough time in the real estate on the real estate season to give them time to really comply with the new requirements. Now, Ms. Maloney is, one of the more strident supporters of CFPB, so I know that she is not suggesting that to stop the CFPB from this activity. But I just wanted the panel's opinion on whether a delay was possible and what impact do they see that this would have.
Thank you for your question. I actually had the opportunity to meet with Director Cordray yesterday afternoon, and I posed that very question and urged him to consider a delay in enforcement, a hold harmless period, because we really do need to test this process, test these forms, and make sure that consumers aren't harmed in the transaction. He was told me, as I think he testified in front of, or presented in front of the Realtor organization earlier this week, that he's still listening. So I think any encouragement from all of you helps further the case that consumers need to be assured that their transactions will move forward as we implement these new forms and this new process.
Okay, thank you for that. The other question I had, and hopefully you're able to, maybe Mr. Polychron might be the best person to ask this question. It's in regard to FHA loans. Many more modest income borrowers, low income borrowers find themselves needing to go to the FHA for their financing because they don't have the 20% down payment. And we have heard concerns from some realty groups, including the realtists, that the requirement that borrowers amortize the mortgage insurance payment over the entire life of the loan means that the poorest borrowers will be paying much more for the loan. And it doesn't seem to have any nexus with added risk factors versus the private mortgage insurance that would phase out earlier and be less expensive. We want to know what your thoughts are on that.
Are you speaking in reference to the down payment being high? Because you started off with the down payment.
What I'm saying is if a person is getting an FHA loan,
What?
and the FHA mortgage insurance is amortized over the entire length of the loan versus being phased out at some point, preventing them from a borrower from developing any equity in the property.
And the mortgage premium she's talking about, yeah. Yeah, okay.
And this is a rule that's been put in place, and I'm wondering if this is an unintended consequence in your opinion.
Yeah, but some other things happened to perhaps offset that. The mortgage premium was reduced, from 1.35 down to 0.85, which lowered the average home that sold through FHA $90, approximately $90 a month. So even though some other things changed that might have, affect it negatively, I think overall with the down payment being lowered again to 3.5% on FHA loans, I think the product has become much more attractive to
Any
all
other
families.
observations about this in my 4 seconds from the other panelists?
I deal with conventional primarily because of that. We are regulated on the requirement to reduce or take the entire PMI premium out of the transaction at 78%. The FHA, the new rules do have 100% MI coverage for the life of the loan.
Yeah,
My time has expired. I don't know that I got it answered, but thank you.
Thank you. With that, we go to the gentleman from Pennsylvania, distinguished gentleman, Mr. Rothfuss, for 5 minutes.
Thank you, Mr. Chairman. Kind of hard to see folks from up here with the new setup. For the panel, I've talked with a popular real estate company back in my district a bit about the TRID rule, and they do expect to have technology ready to comply by the August 1st deadline. This particular company is going to be ready. However, they noted that the large number of settlement service providers they work with also need to be ready if they want all to do business together. Could the panel please elaborate on the interconnectedness of real estate transactions? What could happen if one component in the process is not ready with the needed systems and technology? Ms. Lohman, maybe you'd want to.
I'll start out only because the closing disclosure, which is the new part of TRID, is 100% our responsibility. And in the past, settlement done by the title company, we collaborate the numbers. They can change right up until minutes before closing. And under TRID, that cannot happen anymore. It is locked down 3 days before, which means we have to collaborate with our title companies about 5 days before closing. And when you buy a home, there are expenses and things that happen in that week before closing that we can no longer allow to have happen. So that's going to be one of the biggest challenges of the new TRID rule is the lockdown of that closing disclosure. We have spent the last several months sitting down with our vendor partners, including the title company and the realtor community, saying, how can we do the best job to be where we have to be on August 1st? We don't have all those answers yet.
Anybody else want to comment on the interconnectedness and the impact of one entity not being ready?
Thank you, and that absolutely is true. It is critically important that we all are able to share data directly with one another and to make those changes and make it very timely and seamless so that the time frame set forward in the new rule can be met so that the loans can close without delay. But that last minute change, that need to prorate the gas that's in the propane tank or adjust the homeowners association dues, all those last minute issues that come up are going to be much more difficult to do, and that integration will be critical to accomplish that.
Thank you.
And if I may, ultimately, my client, my couple that's sitting at that closing table, when they find out they're not going to be able to close, has to provide themselves for more, perhaps, rental payments, higher interest payments, moving vans that are sitting there full of furniture that's going to cost more. So there's going to be incurred costs that they wouldn't normally have as well.
And just to add one more thing, and that is the sheer number of vendors that has to be coordinated is just incredible. It's mortgage brokers, the title insurance agents, attorneys, closing or settlement agents, and pest inspectors. I mean, it's incredible.
Thank you. Ms. Lohman, have there been other regulations that you recall where technology hasn't been ready at the deadline for implementation and where federal regulators provided some relief to industry to ensure that they were not going to be adversely harmed?
And do I understand your question to say the technology piece?
Yeah, if to comply with a certain regulation by a certain deadline, if technology wasn't ready, do you recall other instances where the technology just wasn't ready yet and the federal regulators provided some relief?
In my 30-year career in just the mortgage business, there's never been an issue with the technology piece. It's usually been about systems, or not systems, but processes.
Thank you. There will be glitches when TRID goes into effect on August 1st, especially since there currently is no testing phase. What are some challenges industry participants will face that might have been unaccounted for by the CFPB? Anybody on the panel want to address that?
Sir, thank you. I think that's a really good question, and I think that's part of the reason why the delayed enforcement is so important, is because we don't necessarily know exactly what those issues may be. And under the current rule, the buyer-borrower risks losing their earnest money if closing doesn't occur in a timely manner. And the CFPB has acknowledged through their statements that they don't believe that a loss of earnest money is a financial crisis for a buyer. I have to tell you, in my world, as I close transactions, whether that earnest money is $1,000 or $10,000, the loss of that to a buyer-borrower is huge, and the consequence
it's a significant
is
number. Yes. Thank you. I yield back.
Thank you. With that, we go to the gentleman from Texas, Mr. Green, for 5 minutes.
Thank you very much, Mr. Chairman, and the ranking member, I thank as well. Not having been here for the entirety of the hearing because of other duties, I may ask a question that has already been answered, so please tolerate me to the extent that you may. Integrated disclosure, is there anyone among you who is opposed to the integrated disclosure? If so, would you kindly extend a hand into the air or simply say so? Anyone? All right. Now, the time period that we are discussing is about 5 months. Is that enough time to make the transition?
No, it's clearly not. I mean, you know, I think you can argue that lenders really had 21 months, but they didn't, because every system was dependent on every other system, and you know, so so the systems that are being delivered to Ms. Lohman were in turn dependent on MISMO, which is the mortgage information and data system. That was in turn dependent on Fannie and Freddie with their uniform disclosures, which required updating there were 899 data elements in that, some of which had to be updated. So everything, so there was sort of a sequencing. We're getting to the end, and the timeline is very, very tight. So while systems may be mostly in place, they won't be fully integrated. There's going to be a huge manual element, and the people at the end of the line who are going to suffer are going to be consumers with delayed closings.
I think, Ms. Lohman, you were about to give a comment as well.
I would echo her comments completely.
Well, permit me to ask, what would be reasonable in your opinion?
From my perspective, working with my software company is the most strategic part of implementation right now. I'm still waiting to get to that stage. Once we have the software in place and we start testing, I have to pull people out of the field, which means that consumers can't get to their mortgage person for an application, and spend the time training them. And I was looking towards about a 60-day training period, and I won't be able to start that until the end of June at this point.
Moving to another topic, Ms. Lohman, Mr. Ellison was asking questions about affiliates, and you were about to make a comment about 100% zero tolerance. I didn't quite get the gist of what you were going to say. Would you kindly explain?
If a bank is working with an affiliated title company that they may own, TRID says that we have no tolerance for error. So the dollar amount that we put on the early disclosure to the customer, primarily because it is an affiliate of the bank, we cannot have any number that other than what we close with. There is no ability to change that.
And the final question that I'll ask has simply to do with the utilization of the time. If we have a hold harmless period, would you care to explain to me how this time would be effectively used?
Thank you, sir. That time would be used to use these new forms, use the new process in real-life transactions to make sure that we all have it right and that we are able to timely close consumers' loans and make sure that there aren't unintended consequences as a result of this new process.
Anyone else?
I kind of like to compare it to the NFL. They play preseason games that don't count against them. and then all of a sudden when the day gets there, then they play for real. And that's what I'd kind of like to see happen as well.
Thank you very much. I appreciate your analogy. Thank you, Mr. Chairman. I will yield back.
Thanks, gentlemen. With that, we go to the gentleman from Kentucky, Mr. Barr, for 5 minutes.
Thank you, Mr. Chairman. Ms. Evans, I appreciated your testimony regarding your conversation with Mr. Cordray yesterday, and happy to hear that he said that he would be listening and continuing to listen in advance of August 1st. My question to you is, do you expect the CFPB to make any changes without a congressional intervention based on your communications and industry's communications with the Bureau?
I think I would be speculating if I said yes or no to that, but what I do feel confident in is that any kind of encouragement or action that you all would take to help move the need for that change forward would certainly go a long way.
Well, to that point, as you may know, I'm leading a letter and sending a letter to the Bureau with my colleague, Ms. Maloney from New York, to encourage the Bureau to give you all that, that preseason, if you will, so that you can test all of the new procedures. You know, the goal of this new integrated disclosure, of course, is to simplify the process of closing. And yet we see that the regulation itself is a 1,888-page rule in and of itself. My question to anyone who would like to answer is, do you think that 1,888 pages of regulation is too much or too little guidance? Ms. Lohman? Since you smiled.
There's a lot of minutia in there that we're still trying to figure out how that impacts the numbers that we provide for our customers. And as we've read it and had our attorneys read it, we've spent a lot of time trying to figure out what that exactly means to every bit of the documentation that goes to the customer. But, you know, as we put these rules into play, I think this period of time that we're asking for would give us time to try it on, make sure it fits right, go back and forth with CFPB to try to get more clarification without the penalty of closing customers down for closing, where they could lose their rate lock, they could lose the house that they're buying, and lose their down payment.
My understanding is that there are 10 pages of disclosure forms under this regulation, a 3-page loan estimate, a 5-page closing disclosure, and a 2-page disclosure to the person selling. Is this more complicated? Is this a more voluminous amount of paper than the typical closing under the current law?
We had some sweeping changes a few years ago, and that probably was more paperwork than what this is. And that locked down tolerances, which was the concern that the consumer would get a bait and switch, like it's going to cost you this much, but it really costs you this much at the closing table. That all changed several years ago. And as I said earlier, I mean, we've looked at these documents that HUD created and that were part of RESPA for a long, long time. They're not cumbersome. I think it was the training of people who give that disclosure at closing to make sure it's clear to customers, and I'm not sure we've fixed that yet.
Well, I'll stay with you, Ms. Lohman. One other question directed specifically to you. What do you see in terms of the additional costs to consumers and also just generally credit availability impacts as a result of the new integrated disclosure rule?
From what I have sensed so far reading it, the impact of credit availability should not change. The amount of available time to work with customers has changed. It has taken us much longer to do each transaction so we can get fewer people through the process. That shouldn't be different from one shop to the next. It should be universal. I think that's going to be a big impact. And then just monitoring the activity in our shops is costing more money, and if it costs more money to us to do it, it's going to cost the customer more.
And I'm curious about this 3-day advance requirement and some of the challenges associated with the requirement to provide the disclosure 3 days in advance of closing. Can you just elaborate a little bit in my remaining time about some of those additional complexities that could be created?
I have a calendar, but it basically says that on the new rules, the last loan estimate I can issue to a customer with any changes, whether the customer asks for it or whether the realtor asks for it or the title company changes something, is day 4. Day 3 before closing is the day we issue the closing disclosure. Goes to the customer, goes to the title company, that's locked down. If something comes up, like a homeowners association due that we didn't know about, or the fuel bill that we were talking about earlier, then that stops that 3 days. You have to issue a new 4-day loan estimate for the changes, and then a new 3-day closing disclosure, and now your closing is about 4 or 5 days further out.
Thank you for your testimony. Yield back.
Thank you, gentlemen. With that, we have our final inquisitor of the day, the distinguished gentleman from California, Mr. Sherman, who is also the co-sponsor of H.R. 2213. Recognized for 5 minutes.
Thank you, Mr. Chairman. I served for so many years on this subcommittee, and I want to thank you for allowing me to participate in this hearing, even though I'm no longer one of your members. You know, I co-sponsored Dodd-Frank. Not everybody, I think no one else in the room can say that at the present time. For different reasons. I know, for different reasons. And the plan for the CFPB was they wouldn't have to listen to the appropriating committee. They're the only agency in government I can think of that doesn't have to listen to the appropriators. We didn't do that because we thought they shouldn't listen to Congress. Rather, we want both ears focused on the authorizing committee, this committee. This is where the expertise resides. And even if we didn't bring expertise, there should be a certain respect. What is it? Honor your father and your mother, etc. We created this agency right here in this room before it was redecorated. And I like Mr. Polychron's example, comparing it to the preseason. My own example is that this is like a shakedown cruise. You build the best ship you can, but you then take it out and see how it works. And you expect it to float, you expect it to work, but you don't shoot the captain if it doesn't work on the shakedown cruise. You don't even subject him to the American trial bar. You get the bugs out of it. And in this one, I'm seeing some bugs because if I understand Ms. Lohman's testimony and others that I've heard, the slightest little change can delay things for days. So if I was buying a house and I found that the water heater needed to be fixed, instead of getting the water heater fixed at the expense of the seller, which is only fair, I just say to heck with it. I'll fix it myself. I won't tell anybody about it. Last thing I want to do is move into the house 5 days after the school year begins because I want somebody else, in all fairness, to pay for the... So this idea to start over for $50 items or $200 items does not help the consumer. But as I understand the testimony here, you're ready to go with this regulation, with whatever flaws it has, on January 1st. You just want to be able to, actually you're going to implement it on August 1st, but you just don't want to get sued for the problems discovered in the shakedown cruise. I don't know why Congress has to push this hard to get that as the result, but we do have the Pierce-Sherman bill. We are looking for co-sponsors. And it shouldn't take an act of Congress to get a 5-month period in which you do your level best to follow this new law, but you're not going to get sued or penalized during the shakedown cruise. Mr. Polychron, is this, and what I'm hearing from realtors in the San Fernando Valley, is this is already affecting planning for selling homes and buying homes? That people are worried if they can't get their escrow open by August 1st, that they're going to have problems. People are already planning to just take the month of September and October off, which may be good for them and their families if they're realtors, but not good for my area. Are you seeing that around the country? Is the prospect of this highly litigious, people waiting to sue situation already affecting behavior?
Congressman Sherman, you know, Southerners are a little different than people in California, but I will tell you that what we're seeing happen is that our title companies and lenders are telling us to add from 15 to as much as 45 days to a closing to expect it to finally happen. So it's still a delay period, which we don't like.
And right at the time of the school year where I got to move into the house where my kids can't go to that school and they can start 2 weeks late. Oh, that's
all correct, sir.
Is everybody here on the witness? I think you've already said this, but are you all in favor of the Pierce-Sherman bill? I'm seeing nod, nod, nod. I see Ms. Goodman, are you nodding or you're not shaking?
I'm definitely in favor of the hold harmless period. I am not sure that you need to do it legislatively as opposed to, you know, by urging the CFPB to do it, because I really think it's their.
I want to commend Ms. Maloney and Mr. Barr, because they've sent a letter, organized a letter that many of us have signed that have encapsulated the wisdom of Ms. Goodman. And nothing would please me more than throwing away this bill, because the CFPB did exactly what Ms. Goodman suggested. I believe my time has virtually expired, and I yield back.
As usual, the gentleman from California is very articulate and has great points to make. Thank you for your participation in our committee hearing, and you're most welcome. With that, we have our final questioner of the day, the gentleman from Florida, Mr. Ross, for 5 minutes.
Thank you, Mr. Chairman. I don't think I'll take my full 5 minutes, but I do want to comment that, yes, I too am a co-sponsor of the Pierce-Sherman bill, and believe that, you know, as a lawyer, in order to address the potential causes of action, that probably is legislatively necessary. But I just want to address, if I can, Ms. Evans, to you, because as a law student some 30 years ago, before we had computers, we would do an abstract of title by going down to the courthouse and doing the chain of title and taking some painstaking efforts to find out that we had a clean title, and then we would look and go back to the title company and to do the title insurance and put in our exclusions. If this is, if the Pierce-Sherman bill is not implemented, or if there's not a safe harbor, I foresee some title situations that are going to be very painstaking, that in and of itself give rise to litigious causes of action, or maybe other exclusions that title companies will want to put in there. And so I guess from your perspective, what do you anticipate to be the impact if we're not able to correct this and allow for the safe harbor?
Thank you, sir, for the question. I think the largest impact is going to be on the closing and settlement side. I think that the title insurance product, the search and exam, will continue to go forward. I think we will be required to make sure that we're able to search, examine, and provide those products in a shortened period of time. I'm sorry.
Oh, no, you'll have a conditional acceptance, essentially, or a conditional issuance of a title policy that then may give rise to an objection of the mortgagee because it doesn't protect their interest because you're not sure. I guess what I'm suggesting is that until we get this cleared up, and until you, which by the way I think has probably one of the most significant impacts on a transaction because of the depth of the title history, that we have to have that cleared up. And I guess what I'm concerned about is you've got to protect your interest. And if you don't do it through an exclusion or a conditional issuance, then you do so at your own peril.
Well, we want to make sure that that home buyer's investment is protected.
Correct.
And they get a product that well covers that commitment that they've made to purchase that home.
I agree with you. And in order to have that satisfaction that you know that that home buyer is protected, you need some sense of certainty, correct?
Absolutely.
Chairman, I yield back. Thank you.
Thank you, gentlemen. And obviously things on the floor have broken down because we're an hour late with votes. So thankfully, and for your benefit anyway, that happened. Again, thank the witnesses for participating today. You guys did a fantastic job. But I do want to send a message to CFPB. I think from the hearing that we had today, it's the forbearance period is agreed to by all parties, both sides of the aisle. And I think that if a forbearance period is not granted, it's incumbent on this committee to monitor that situation. And so it's my intention to contact all the various lender associations and get with them to, if the forbearance period is not agreed to have them get with us and give us examples of extreme abuses by CFPB if they pursue this and go down this road. Hopefully they will be good stewards of our citizens' time and monies, and this will not happen, but should they not do that, we want to know about that, and we will contact with a lot of the representatives from the different lending groups to make sure that we monitor this situation very, very closely. With that, without objection, all members have 5 legislative days within which to submit additional written questions for their witnesses to the chair, which will be forwarded to the witnesses for their response. I ask our witnesses to please respond promptly as you are able. And without objection, all members have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. With that, this hearing is adjourned.